You are not losing money because you are unlucky. You are losing money because the system moves in seasons and nobody tells you when the season changes. The first lie you were sold is that long-term investing is the same as buy and forget. It is not. In every real cycle, capital rotates like water through a broken wall. It floods one corner, then it leaves another corner to dry out. If you bought in the wrong season, you can be right about the company and still get wiped out. This is not financial advice. This is financial education, and it is the kind of education that makes people angry because it explains why you felt safe right up until you weren't. In 2026, most people are watching the wrong screens. They watch headline inflation like it is a scoreboard that goes down and means everything is fixed. They watch the stock market hit new highs and assume the economy is doing well. They watch mortgage rates and think the problem is interest rates alone. But the real problem is older than you, older than the Fed, older than any election. It is the rotation of money between asset classes, between currencies, between risk and safety, between real production and financial claims. And here is the part nobody wants to say out loud. You cannot outsave a cycle. You can only survive it. And survival depends on timing, not vibes. I want to walk you through a framework that sounds simple, but it is ruthless in practice. The global economy runs in phases. Different phases reward different assets. In the wrong phase, even good assets can become traps. In the right phase, even boring assets can print money while everyone else is busy panicking. You do not need magic. You need pattern recognition. Two data points, used correctly, tell you where you are. GDP momentum and inflation momentum, that is it. That is the entire engine. Everything else is just noise wrapped around that engine. Now take a breath, because the next parts connect directly to what is happening in your life right now in 2026. AI is eliminating roles faster than most people can retrain. Hiring freezes are common even in companies that are still profitable. Your salary might be rising on paper while your purchasing power quietly rots. Housing costs are detached from wages in the United States, the United Kingdom, Canada, Australia, and even parts of Europe. And insurance markets are tightening because climate risk is becoming a balance sheet item, not a distant prediction. And while real people struggle, the wealthiest households keep compounding because their assets are positioned to benefit from the same cycle that crushes you. That disconnect is not accidental. It is the visible result of invisible timing. So let's start with the oldest phase in the world, recession. When the economy is in recession, GDP falls and inflation usually falls too, sometimes all the way into something like deflation. That is when businesses stop planning for growth and start planning for survival. Hiring freezes become layoffs. Demand disappears. People stop spending because they fear unemployment. When people stop spending, companies stop selling. When companies stop selling, they cut costs. When they cut costs, workers lose incomes. When workers lose incomes, demand collapses again. This is not philosophy. This is a loop. Think about the simplest domino chain. A small manufacturer has fewer orders. Their revenue drops. They stop buying materials. Their suppliers' orders drop. Their suppliers' employees work fewer hours. That supplier sells assets to raise cash. The asset sales pressure prices downward. And then the financial system decides risk is risk, even if the business is not bad. It just became illiquid at the wrong time. Now picture a micro story. A 32-year-old nurse named David. He works nights. He has always been responsible. In 2020, he avoided debt. In 2021, he started investing small amounts. Then in 2023 and 2024, his hospital begins reducing shifts because patients delay non-emergency procedures. David's overtime dries up. He still pays rent. He still buys groceries. But he stops contributing to investments for a while because he needs cash. One day, he opens his brokerage account and sees the balance down. He tells himself he will wait it out because the market always recovers. But in a recession phase, recovery is not automatic. It is selective. Some assets get bailed out. Some assets get abandoned. And if you pick assets that are punished in that phase, you can wait for years and still underperform or even lose principal. In recession, most people are broke twice. They are broke because income weakens, and they are broke because asset prices fall. So what does the cycle reward in recession? Not stocks, not new startups, not the dream of passive income. It rewards assets that survive while everyone else is losing. That typically means government bonds and cash-like instruments. It also means holding the currency that global investors treat as the last safe harbor. But even that sounds abstract until you connect it to rates. In recession, central banks cut interest rates. When rates fall, bond prices tend to rise. This is the part people hate because it sounds too mechanical. But it is mechanical. If you own a bond yielding higher than the new lower rate environment, you benefit because the market revalues your higher yield. In 2008, the United States moved toward near-zero policy rates. Investors rushed into safety. Government bonds rallied. Many risk assets cratered. That is the recession script. Now here is a modern twist you must understand in 2026. Money is not just moving in domestic markets. Global capital is searching for safety in real time across currencies and instruments. When stress hits, investors do not want complexity. They want liquidity and trust. That is why the dollar remains dominant in many crisis episodes. Even in a world where people complain about the Fed, in a panic, investors still reach for the same tool. But listen carefully. Recession often contains two truths at once. Bonds can rise in the short run because of lower yields, but the currency can also be a trap in the long run if the system chooses to expand the money supply aggressively. That is why timing matters in both directions. So the recession strategy inside this cycle framework is usually the same order. First, bonds or bond-like safety. Second, cash in the sense of the reserve currency. Stocks can be optional, and often they are better approached later because stocks reflect future earnings, and future earnings keep getting revised down in recession. And here is the cliffhanger you need for the next phase. Recession punishes risk assets, but it also creates the material for a brutal transfer of wealth. When the economy stops bleeding and starts recovering, whoever has cash and safety assets positioned correctly becomes the buyer while everyone else becomes the seller. But how do you know when recession is over? You do not wait for optimism. You wait for inflation momentum to stop collapsing and for GDP to start turning. Then the market shifts from survival mode into rebuild mode. That shift is the difference between being a spectator and being a predator. Welcome to recovery. In recovery, GDP growth returns, but inflation can remain subdued. That means businesses begin to sell again, they rebuild inventory. Hiring slowly returns, borrowing becomes more tolerable. Demand returns before supply catches up, but pricing power is still limited because consumers are cautious. This is the phase where stock prices can rally hard because earnings expectations rise. It is also the phase where certain commodities may not explode yet. If inflation is still low, businesses can be reluctant to raise prices. They may still be clearing the backlog from the downturn. Now picture a different microstory. A warehouse worker named Maria, 40 years old, living outside Chicago. She works for a logistics firm. In a recession, her hours shrink. She starts borrowing from credit cards. In recovery, orders come back, but she does not feel rich because her credit card interest is crushing her. She looks at her phone and sees market charts going up, but her personal finances do not automatically improve. This is why the stock market and real life can feel out of sync. In recovery, stock prices respond to expectations and liquidity. Meanwhile, households can still be stuck in debt traps that were created earlier when cash was scarce. So recovery rewards those who understand the difference between market liquidity and personal cash flow. The cycle framework does not care about your feelings. It cares about which assets are most supported by policy and by the demand environment. In recovery, stocks are often the best performing category. Bonds can still do okay, but their upside may be limited because yields can start creeping up again, or because the initial panic-driven bond rally has already happened. Then something changes again. The cycle escalates. If GDP is rising and inflation starts rising too, you enter the hot phase. People call it too much growth, overheating, or the last mile of inflation. This is the phase where everything feels great, right until it does not. In a hot phase, both GDP and inflation are increasing. Central banks usually try to slow things down by raising rates, but markets do not stop moving just because someone in authority says tightening. If the economy is still strong, corporate pricing power can support profits. Wage growth can keep demand alive. Supply constraints can push input prices up. Now connect this to 2026 reality. In many places, inflation has come down on official numbers, but that does not mean your costs came down. Housing is still expensive. Insurance is spiking in climate-exposed regions. Food prices can fluctuate but do not collapse into 2019 levels. And even if headline inflation stabilizes, the distribution of inflation is brutal. It hits rent, it hits health costs, it hits energy, and it hits transportation. So people live with higher costs while hoping that policy will save them. Meanwhile, big money does not hope. Big money positions. In the hot phase, where should capital rush? Often toward commodities and energy and assets connected to real production. Think metals, industrial inputs, energy supplies, and anything that benefits when pricing power and input demand are rising together. And yes, this is where people with money start selling earlier winners. They sell high when valuation and supply dynamics get stretched. They stop buying the most obvious narrative and start buying the next phase's winners. This is also where AI and automation intersect with the cycle. When inflation is high, businesses want to protect margins. They invest in efficiency, and that means cutting labor-intensive roles. So the AI replaces job story is not just tech disruption, it is a profit survival mechanism inside an inflation-hot environment. Companies replace workers with automation because labor is expensive. You watch them announce productivity gains, and you watch your job market tighten. Now here is the hard truth. In a hot phase, you are trained to believe the future is bright. That is why people chase stocks at the peak. They ignore timing and focus on narratives like this is the future. But when inflation is high, the future is expensive. Margins get squeezed. Borrowing costs matter more. And when central banks tighten further, the hot phase begins to break. Then you get the next phase, the one everyone misreads because the name sounds like a small problem. Stagnation with inflation. In this phase, GDP weakens while inflation stays stubborn. This is what people experience as, the economy is slowing but prices are still high. It is the nightmare combination, and it is the reason you feel trapped even when the official inflation number improves. How does this phase happen? Rate policy has lags, you tighten today. Economic pain shows up later. But prices can remain elevated because supply constraints take time to unwind, because firms pass through costs, because energy and commodities can remain expensive. In 2026, this is not hypothetical. You have seen it across multiple sectors. Manufacturing is disrupted by global trade tensions. Supply chains are expensive to maintain. Shipping costs and insurance costs fluctuate with climate risk and geopolitical events. Energy pricing remains volatile. So even if you get an inflation cool down, you do not necessarily get the purchasing power recovery that people were promised. Now connected to the financial markets. When GDP weakens but inflation does not cooperate, stock valuations struggle. Companies start cutting costs. Layoffs become more common. The market can still bounce, but the trend becomes unstable. Meanwhile, rates are often high enough to pressure bonds at some points, especially if inflation expectations stay elevated. This is why the cycle framework stops treating diversification like a religion. Diversification is not a magic spell. If everything is priced off the same currency and the same policy expectations, then diversification is often just holding different versions of the same bet. In the hot and stagnation phases, what happens to asset allocation strategies that are designed for stability? They fail. Someone will tell you to hold half stocks and half bonds and call it risk managed. But if the bonds are pressured by inflation or by changing yield expectations, and stocks are pressured by weakening growth, that balanced portfolio can bleed from both sides. And yes, currency matters. Many assets are not truly separate if they are all tethered to the same reserve currency. If the reserve currency loses value over time, you can have nominal gains that still look like losses in real purchasing power. Now you can see why the cycle framework is harsh. It says, in stagnation with inflation, cash becomes king. Let that sink in. Cash becomes king even though cash is usually considered boring. But cash here means cash and cash-like short-term instruments that let you survive and move quickly when panic sales happen. In stagnation with inflation, businesses earn less and need to cut. That means they stop expanding production. When production stops, commodity demand softens. When demand softens, prices can collapse. When prices collapse, firms selling industrial inputs rush to liquidate. That liquidation can cascade. And in that environment, what buys first when everyone else is desperate? The people with liquidity. This is where the story returns to the famous names you hear about. People love to believe Warren Buffett is just a stock picker. But at the cycle level, you can interpret his behavior as a strategy of being liquid enough to pounce when assets are mispriced by fear. Also, you have to understand how modern wealth managers operate. Large institutions like BlackRock, major banks, and large asset managers can move capital with speed and can also shape flows through funds and derivatives. Their allocation decisions are not merely personal, they are structural. They are tied to managing massive pools of money and meeting risk constraints. So while you are trying to decide whether to buy the next dip, they are deciding which phase you are in and which corner of the market is about to get crushed. Now the cycle framework says something else that feels offensive. The timing rules apply across asset classes, not just one. The winner in one phase becomes the loser in another phase. That is why people who only buy one category often get punished across multiple cycles, even if they are right in the long run. A person who buys only stocks can look brave in recovery and then be trapped in stagnation. A person who buys only bonds can look safe in recession and then be crushed by long-term inflation damage. A person who buys only gold can do well in fear phases and then suffer during transitions when gold stops being the best hedge. It is not that the assets are fake, it is that their relative role changes. In 2026, you can see the same pattern playing out with crypto, even though people treat it like a separate universe. When liquidity tightens or when institutions dominate the market, what was supposed to be decentralized becomes regulated, concentrated, and tied to institutional risk management. In other words, crypto increasingly behaves like a financial risk asset with special hedges, not like a guaranteed escape from cycles. Banks have also taken control of more crypto infrastructure than retail investors realize. Regulation and custody and exchange partnerships concentrate power. That means in many downturns, retail gets squeezed while institutions manage exposures. So when you hear someone say this asset is independent of the cycle, ask yourself a brutal question. Independent of what? Liquidity? Liquidity is the cycle's bloodstream. Now we reach the part where the original story becomes useful in a real, Western 2026 context. Which assets tend to do well in which phase, and how money rotates. In recession, bonds and reserve currency safety tend to hold up. In recovery, stocks can surge while inflation stays muted. In hot inflation, commodities and real assets tied to production often benefit. In stagnation with inflation, liquidity, cash-like instruments and defensive moves dominate, while many cyclical assets can suffer. But you still need one operational tool. You need a way to tell where we are inside the cycle before it is obvious to everyone. Otherwise, you are always late. The framework's operational method is simple. Watch GDP direction and inflation direction. GDP falling and inflation falling means recession. GDP rising and inflation falling or stable means recovery. GDP rising and inflation rising means hot phase. GDP falling and inflation still rising or sticky means stagnation with inflation. Now you might object. Inflation is down. GDP is not collapsing. The market is strong. Those arguments are usually emotional, not analytical. Markets can still rise because expectations adjust and because policy liquidity can postpone pain. But cycles are about momentum in those two metrics, not about 1 month's headline chart. And yes, this framework is brutal because it implies something most people do not want to accept. If you wait until the crowd agrees, you are already late. By the time the news is clear, the assets that benefit most have already repriced. That is why the people who appear lucky are not lucky. They just understood which phase they were in and which phase was coming. Now we go even darker, because most people never learn the real consequence of being late. When you are late, you become the seller of last resort. You sell into fear because you need cash for rent, for medical bills, for childcare, for the broken car that turns into a financing emergency. Meanwhile, the buyer is the person with liquidity who is positioned correctly for the cycle. That transfer can happen quietly, over months, not like a movie. This is what wealth inequality really means in the cycle language. The top 1% is not just richer, they are better positioned for the phase shifts. Their assets can move faster, their access to credit can be cheaper. Their ability to absorb drawdowns is larger, and because they are positioned earlier, they can buy when prices are dislocated. Globally, this happens while total debt keeps rising. We are living in a world where global debt is now over $300 trillion. That debt creates sensitivity. When financing costs rise or when growth weakens, defaults and restructurings become more frequent. That increases liquidation risk, and liquidation risk is where cycles become violent. So in stagnation with inflation, when growth weakens and financing costs bite, you often see corporate stress, you see layoffs, you see credit spreads widen, you see funding markets tighten. And when those things happen, liquidity becomes king. Whoever lacks liquidity gets forced to sell first. Now, this is where I want you to imagine a family. Not a cartoon family, a real one. A couple in their late 30s, 2 incomes, 1 child. They rent because buying would mean decades of stress. Their retirement accounts are tied to broad market funds. They have a mortgage on a cheap house or they rent, but either way their costs rise with inflation. They watch the stock market go up and assume retirement is fine. Then their job market tightens because AI adoption changes their industry. Hours drop, overtime disappears. Expenses do not disappear. They do not have time to wait for the cycle. They do not have time to stay invested. They need cash today. That need forces selling. That selling at the wrong time locks in losses, which then compounds through behavioral spirals. They recover less next year because they are starting from a smaller base. This is the human version of asset rotation. So what does empowerment look like? If we do not lie to ourselves. Empowerment is not pretending you can predict every tick. It is understanding the phase shifts well enough to